Well, today's February 21st, 2023. Stock market took a drubbing today, and we're getting statistics on the real estate sales, what we've been talking about for the last 3 or 4 months, and we've been warning about since March of last year, and we're starting to see the statistics that are verifying what we've been talking about. Let me go to my next slide, and let's talk about that. Now, we've been talking about liquidity. Now, last video we talked about the liquidity and the ramifications of it, but look what's happening. We're getting vindication as liquidity dries up and rates rise. What a surprise. There's fewer and fewer real estate sales, and we're starting to get the statistics. Look at this. Now, we're going to just remind you that we've been talking about liquidity. So M2, peak liquidity was March of 2022. That is also when the real estate markets across the United States peaked, March and April of 2022. Now, before then, you couldn't keep a house on the market. They were just flying off the shelves. You just couldn't get it. Since then, the Federal Reserve is removing $90 billion a month. That's $1 trillion a year, and the economy is slowing radically. So let me go to my next slide. Now, the cost of sales has gone up incredibly. It's almost doubled. We went from about 3% to 6.5%, in some places 7%. So you know when affordability just falls like a rock when interest rates go up. What do families buy? They buy the payments. They don't necessarily buy the house. You know, if you have cash, you can buy anything you want, but most families don't have cash. Most of them mortgage. Most of them save and save and save to come up with the down payment. And they're strapped by the payments. And of course, the payments have gone up a whole bunch, 20, 30%, $1,000, $1,500 is not unusual. And we've been telling people to buy these, you know, always stretch as much as far as you possibly can to get as big a house as you possibly can, because those payments are fixed. So if you don't buy a house of your own, you are going to be renting. And a house of your own has a fixed payment, renting does not. And of course, the shortages continue and actually getting worse. So everybody needs a place to live. So we anticipate rents are probably going to rise. So if you don't own a house and you have a fixed rate mortgage, those monthly payments are just going to keep going up and up and up. Good for us as investors, probably pretty bad for the families that we work with. But look what's going on now. We've been talking about this, so we're getting statistics back. Here's KB Homes. Now Q4 2022, KB Homes, which is a national home builder, is a huge national home builder. They experienced a 68% cancellation rate. Now, how in the world can you have a 68% cancellation rate as a builder? You know, you sold all these homes like 12, 18 months ago, and you're in the process of building them. In the process of building them, rates have gone up. And now the buyers that you sold the houses to can't afford, and all of a sudden a huge cancellation rate, and you get a bunch of specs, scares the bejeebies out of the builders, because they are not spec builders. They're building these properties for someone. And as someone's there to buy the house from them. They've customized it, they've done all the work, and now the rates have gone up from 3 to 6.5, and they're up $1,000, $1,500, and these people cannot afford the house. Hence, a 68% cancellation rate for Q4 of 2022. If you don't think that's a little tough being a builder, you really need to think that one through. Now, this is just going to show what's going on in existing homes. So finally, we're getting the statistics. Remember, they're always 60, 90 days behind. And for the 12th month in a row, we've had existing home sales. The sales numbers have dropped. Year over year, it's down 37%. Year over year in existing home sales. That's worse than when we had the COVID recession, which is right here. It just dropped like a rock. Thank goodness it was vicious, but it was short, and it bounced right back. Housing was really not hardly affected at all. It's only a couple of quarters, and things were just off to the races. But look at here. We've had a steady decline for over a year. Houses have just been declining, have been dropping, and now we're already back to what it was in 2007 and 2008. And we are just getting started. So sales are dropping like a rock. Now, this is coming out of the National Association of Realtors talking about the one-year change from January 22 to January 2023. And they're doing it by price ranges. Now here's the least expensive one, is $0 to $100,000. They've been impacted the least, only 25%. Now, can you imagine only 25% drop in sales up to here to $1 million plus, which is the luxury home? They've incurred a 41% drop. Now that's huge. These are huge. Now here in Phoenix, when we're buying most of our properties, remember we're very affordable housing here to begin with in Phoenix, Arizona. Most of our homes are sold around $350,000 to $400,000. We've experienced a 31% drop in that price range, which is good for us. I'm going to tell you, a year ago we were fighting everybody to even find a house that was worth buying. Now we've got our choice. There's all kinds of really, really good properties to buy. Rents are about the same, so our cap rates are pretty strong. We're really happy with that. But sales have dropped 31%. That's a harbinger. And we're just getting started. Keep in mind, we always talk about that lag. So it's 9 to 15 months for the lag. And so we had our first increase of only 0.25% in March of 2022. So we're just coming up to feeling the effect of that very first interest rate increase. So it's only going to get worse from here. So now, I talked to Dr. Nenner, and Dr. Nenner said we would have a lower of interest rates for a very short period of time. We did do that. And I think we're at that window of lower interest rates is probably coming to an end. So if you're going to do something, you should do it pretty doggone quickly here. Let me get my next slide here. Let's just talk about that. So look at for building conditions for buying homes. It's just coming off the chart. It's the same as what it was in 1982 when Paul Volcker was raising interest rates, destroyed the economy, he certainly stopped inflation, but destroyed the economy. It was really, really terrible. So we're there. We are going to be looking at this. This was epic. This is going to say, oh my goodness, I remember living through this, because this is going to be some kind of a event. Now, this is what we talk about. So as you start seeing sales decline, that means listings will start piling up on a marketplace. So when you have sales decline and you have more and more listings, then the next thing you're going to do is you're going to start seeing prices come down. Now in California, it lost 400,000 residents last year. Arizona gained an awful lot of them. Florida and Texas gained an awful lot of them. We're going to be affected the least of all of them, but we're going to be affected a little bit, but nothing like California, Portland, Seattle, Washington, the state of Washington, really, all of Minnesota, Wisconsin, Illinois, and Chicago area, New York, New Jersey, all these states where people are leaving. Now, people are leaving California because of rising tax rates. You got tech layoffs, you got lots of crime, socialist issues, high taxes. And in San Francisco, 56,000 residents left. That means they sold their house and left. There's no more housing. The housing pressure is really a lot less. And the prices have come down 35%. Now, I'm not talking about sales. Sales have slowed too. We're talking about price declines of 35%. From $2.2 million, it's dropped 35%. That's like $700,000 to $800,000 in price change. $700,000, a lot of money for it to have changes, and that is what's happened. So let me go to my next slide. Now look what happened in 2006 and 2007. Basically the same thing. This is the Bay Area. We get this from Wolf Street. So this is we love this one. We got this from Zero Hedge as well. But take a look. They look very, very similar. See this peak right here? Look at that peak. Look at this. And let's look at this one right there. Kind of like the same, peak 1, peak 2, and then we have a waterfall effect. I think that's just forming now. I think this one is going to waterfall a little bit more, and this is in the Bay Area. I think they're going to be leading the pack. I think it's a little ways out yet, but it's certainly coming. So let me go to my next slide here. So what does this mean for you? What does this mean for you? Well, I'll tell you. It means that you need to be selling those assets that while you have a chance, while you're still in that window of lower interest rates, you should be selling those assets that don't cash flow. If you get something that you want to sell, you need to get it on the market and get it sold. Now, if you're doing a 1031 exchange from California, you say, oh, I could have gotten more money last year. Yes, you could have gotten more money last year. But wherever you're going, so you don't get as much in California, you're not going to spend as much in Arizona because our prices have come down a little bit. Not as much as California, but not as bad. So you still have a wash. So it's risk capital. So by all means, do your 1031 exchanges. I think that's fine. If you're moving from one state to another state, you have no choice. Go ahead, get into the housing market. What you didn't get in Wisconsin, you're not going to have to pay elsewhere. Arizona's less than probably Wisconsin, but a much better growth period for yourself. And if it's a non-cash flowing asset, you need to go ahead and sell that while you have an opportunity to get that done. So let me go to my next slide and do my CYA, and we can talk about that. Now, I am here in Phoenix, Arizona. West USA holds my real estate license. My whole group here, we're all pretty good at what we do. Now, West USA is a $5 billion firm. You're welcome to reach me at the corporate number or at Michael DeVille at michaeldeville0@gmail.com, and you can email me. Now, I think things are going to get worse. Let's get together if you want to talk. I'm more than happy to talk to you and your spouse and your financial advisor. Let me know if we can do anything to help you, and my very, very best to you. Bye-bye now.